Indirect taxation. Lesson 14. Concept of indirect taxes at a glance. Indirect tax is a tax you pay on goods or services, but not directly to the government. Instead, the tax is collected by sellers or providers and passed on to the government. It means the tax burden is indirectly borne by the consumer through higher prices. Key points. Indirect tax is charged on goods and services. Levied on consumption, not on income. Collected by intermediaries, retailers, service providers. Examples. GST, excise duty, customs duty. Causes prices of products services to include tax. Broad tax base covering many goods and services. Cascading effect occurs if taxes are levied on tax pre-GST problem. Administered in India by Central Board of Indirect Taxes and Customs CBIC. Indirect taxes impact spending patterns of consumers. Regarded as regressive tax since low and high income pay same rate on goods. Indirect taxes in India. An overview. India used to have multiple indirect taxes levied by both central and state governments on goods and services. Before GST, there were taxes like excise duty, VAT, service tax, customs duty, entry tax, octroi, etc., leading to complexity and inefficiency. Key points. Indirect taxes were split between central and state governments. Examples include excise duty central, VAT state, service tax central. Multiple taxes led to tax on tax and higher costs called cascading effect. Different states had different tax rates causing confusion. Interstate movement of goods was hindered due to various state taxes. Tax administration was complex and prone to evasion. Lack of uniformity affected economic growth. GST unified these indirect taxes to simplify taxation in India. Pre-GST indirect tax regime. Before GST, India had a fragmented indirect tax system with taxes at various points like manufacturing, sale, and service. This system caused cascading of taxes, multiple tax authorities, and lack of credit for taxes paid at previous stages. Key points. Multiple indirect taxes were levied separately by state and central governments. Excise duty on manufacture, VAT on sale, service tax on services. No input tax credit mechanism across states, causing tax cascading. Overlapping of tax on goods and services created confusion. Taxes like octroi and entry tax restricted free movement of goods. Administering various taxes was burdensome for businesses. Tax rates varied by state leading to competition among states. Overall tax burden increased prices and affected consumers. Pre-GST tax structure and deficiencies. The old tax system had several defects such as cascading effect of tax on tax due to no seamless credit mechanism. Multiple taxes and cesses increased burden. Overlapping taxes on hybrid transactions like works contracts. Origin-based tax system causing rivalry among states and lack of common market. Complex compliance and administrative difficulties. Key points. Cascading effect increased product prices. Multiple taxes made compliance complex and difficult. Conflicts over whether a transaction is goods or services led to dual tax. Origin-based tax collection affected interstate trade. Different tax rates and laws in states encouraged tax evasion and complexity. Tax system lacked transparency and efficiency. Need for GST in India. GST was introduced to create a single, unified tax system by subsuming various indirect taxes. It aimed to remove cascading of taxes, simplify tax structure, enhance compliance, and create a national market. Key points. GST removes cascading tax effect, leading to lower prices. Unifies multiple indirect taxes into one system. Single tax for goods and services across India. Simplifies tax compliance and administration. Encourages free movement of goods across states. Boosts economic growth and increases tax revenue. Enhances transparency and reduces corruption. Creates a common national market by uniform tax rates. GST includes input tax credit mechanism. Journey of GST in India. GST concept was introduced in 2000, with various committees and bills before it was finally implemented on the 1st of July 2017. It involved amendments to the Constitution and formation of GST Council. Key points. Concept introduced in 2000 under Vajpayee government. Empowered committee formed in 2004 to design GST model. Multiple bills and discussions between 2006-2016. 101st Constitutional Amendment Act passed in 2016. GST Council formed to decide rates and rules. GST launched on the 1st of July 2017 across India. Replaced various earlier indirect taxes. Marks one of the largest tax reforms in India's history. What are outside the purview of GST? Some items are not covered under GST and continue under old tax regimes. These mainly include alcohol for human consumption, petroleum products like crude oil, petrol, diesel, natural gas, electricity. Key points. Alcohol for human consumption is taxed by states separately. Petroleum products currently outside GST, taxed by earlier laws. Electricity is also outside GST, taxed by states as before. These exclusions may change subject to GST Council decisions. Other general goods and services are covered under GST. What is subsumed within GST? GST subsumes various central and state indirect taxes into a single tax system to avoid duplication and cascading. Key points. Central taxes subsumed. Central excise duty, service tax, additional excise duties, special additional duty of customs SAD, central sales tax CST. State taxes subsumed. Value-added tax VAT, entry tax, octroi, luxury tax, entertainment tax, purchase tax. GST applies both to goods and services along supply chain. Basic customs duty and certain cesses remain outside GST. Subsuming these taxes simplifies compliance and reduces tax burden. Constitutional powers of taxation. The Constitution distributes taxation powers between the center and states listed under different schedules. It governs who can tax what and ensures taxation is authorized by law. Key points. Taxation powers are defined in the 7th schedule of the Constitution. Center has power to levy taxes listed in Union list. States have power to levy taxes in state list. Concurrent list does not include taxation powers. Laws governing taxation must be authorized by Parliament or state legislature. Article 265 states no tax can be levied without law. Central and state governments have distinct but complementary taxing powers. Disputes resolved by constitutional provisions. Provisions related to GST under Indian Constitution. GST was introduced through the 101st Constitutional Amendment Act, inserting Article 246A and other provisions to regulate GST. Key points. Article 246A empowers both Parliament and state legislatures to make laws on GST. GST is a concurrent subject with coexisting powers. Amendment included provisions for dual GST structure. Central GST CGST and state GST SGST. IGST integrated GST introduced to tax interstate supplies. Constitution sets the framework for GST Council and its powers. Provisions ensure smooth administration and enforcement of GST laws. Newly inserted Article 246A. Article 246A in the Constitution gives concurrent power to both center and states to legislate on GST. Key points. Empowers center and states to tax supply of goods and services. Foundation for dual GST model in India. Enables smooth taxation on intrastate and interstate supplies. Ensures GST laws can be enacted by both central and state governments. Essential for implementation of GST regime. Goods and Services Tax Council. The GST Council is a constitutional body formed to decide GST rates, rules, and policies jointly between center and states. Key points. Created under Article 279A of the Constitution. Chairperson is the Union Finance Minister. Members include state finance ministers. Decides tax rates, exemptions, thresholds. Resolves disputes between center and states on GST matters. Ensures cooperative federalism and uniform tax regime. Meets regularly to review GST implementation. Decisions generally passed by consensus. Administrative mechanism at the central level. The Central Board of Indirect Taxes and Customs CBIC administers GST and customs at the central level. Key points. CBIC under Ministry of Finance is the nodal agency. Responsible for GST enforcement, tax collection, policy implementation. Coordinates with state GST authorities for smooth operation. Handles customs duties on imports and exports. Ensures taxpayer compliance through audits and investigations. Facilitates taxpayer services and grievance redressal. Manages GST network GSTN for registration, returns, payments. Plays crucial role in capacity building and training. Based on the web search results and existing knowledge, here is a simplified, clear, and exam-friendly explanation of the basics of goods and services tax GST in India, covering the topics you listed. Meaning of GST. GST is goods and services tax, an indirect tax levied on the supply of goods and services. It replaces multiple taxes like VAT, excise duty, and service tax with a single, unified tax system across India, making taxation simpler and transparent. Key points. GST is a multi-stage and destination-based tax. It applies at every stage of the supply chain, from manufacture to final sale. It is paid by the final consumer, but collected and remitted by businesses. GST subsumed many earlier indirect taxes to reduce confusion. Examples. When you buy a car, GST includes tax on manufacturing, sale, and final price. Continuous chain of tax credits. GST allows businesses to claim input tax credits for the tax paid on inputs, raw materials, or services used for production. This creates a tax credit chain. Tax paid at earlier stages can be offset in later stages, avoiding the cascading effect. Key points. Input tax credit reduces the total tax payable. Example. If a manufacturer pays GST on raw materials, they can claim this as a credit when paying GST on finished goods. Ensures only the value added at each stage is taxed. Promotes transparency and reduces overall tax burden. GSTN Goods and Services Tax Network. GSTN is a technological platform that supports the administration of GST. It manages taxpayer registration, filing returns, and tax payments on a shared IT infrastructure. Key points. A common online portal for all GST transactions. Ensures smooth flow of data between taxpayers, government, and GST authorities. Helps in easy compliance and monitoring. Supports input credit claims and refunds. GST model in India. India follows a dual GST model, where both the central and state governments levy and collect GST, with similar rules but different rates. Types. CGST Central GST. Collected by the central government. SGST State GST. Collected by state governments. UTGST Union Territory GST. Specific for union territories. IGST Integrated GST. Levied on interstate between state sales, collected by the center and apportioned to states. Integrated Goods and Services Tax Act, 2017. This law governs interstate supply of goods and services under GST. It ensures uniformity and simplifies tax collection for transactions crossing state borders. Key points. Applies to goods and services sold between states. Collected by the center but shared with states. Keeps the supply chain seamless across India. Nature of supply Sections 7 to 9 of the IGST Act, 2017. These sections define what constitutes a supply under GST. A supply includes sale of goods and services, transfer, barter, exchange, import-export of goods and services. Certain goods services considered as supplies even if given free or as gifts. Supply in territorial waters. Section 9 of the IGST Act clarifies that supplies made in territorial waters such as near the coast are subject to GST just like inland supplies. This covers activities in maritime zones. Definitions. Various definitions in GST laws. Clear definitions help interpret GST provisions, such as what is a supply, what qualifies as a goods or services, what is a taxable person, how to classify goods services. Union Territory Goods and Services Tax Act, 2017. Law governing GST in union territories like Lakshadweep, Chandigarh. It largely mirrors the regular GST law but applies specifically to territories that do not have their own legislature. Key points. Applies to union territories without legislatures. Ensures they follow a unified GST policy. Implements provisions for special territories like Jammu and Kashmir after 2019. Applicability of UTGST and GST on J&K, Ladakh. GST and UTGST are applicable to union territories including J&K and Ladakh. Special provisions exist for these regions to ease compliance and collection. Merger of Daman and Diu and Dadra and Nagar Haveli. These two union territories were merged and now function under a unified administrative and GST framework. Simplifies tax administration and compliance. Administration and powers of officers. GST officers are empowered to register taxpayers, conduct audits, enforce compliance, collect taxes, issue notices and penalties, levy and collection of UTGST. UTGST is levied on supply of goods and services within union territories at rates similar to SGST. Exemption from GST. Some goods services are exempted from GST, such as essential food grains, healthcare services, education services, certain agricultural products, small taxpayers with turnover below thresholds. Payment of tax. Taxpayers must pay GST periodically, monthly, quarterly through GST portal. Payments can be made via electronic methods and returns filed online. Utilization and order of input tax credit. Input tax credits can be used to pay GST on output sale. The order of utilization. IGST credit can be used for CGST, SGST, or IGST liabilities following prescribed rules. Transitional input tax credit. When transitioning to GST, businesses can claim credits for stock of inputs like raw materials, tax paid on previous purchases. This helps in smooth switch over from old taxes. Advance ruling. Business entities can seek clarification from the GST authorities on specific issues before compliance. Provides legal certainty and avoids disputes. Rules, regulations, and instructions. Authorities can frame rules and issue instructions for smooth implementation. Laws are laid down for registration, tax filing, refunds, audit procedures, etc. Compensation to states. The central government compensates states for revenue loss due to GST for 5 years. Compensation payments are funded through GST compensation cess, collected on luxury and sin goods. Basics of goods and services tax GST in India. Meaning of GST. Goods and services tax GST is an indirect tax levied on the supply of goods and services. It is a destination-based, multi-stage tax that is charged at every stage of the supply chain but is ultimately paid by the final consumer. GST subsumes many earlier indirect taxes like VAT, excise duty, and service tax, making the tax system simpler and uniform throughout India. Definition of GST. A comprehensive indirect tax on goods and services, replacing multiple indirect taxes to create one unified tax system in India. It is charged at every point of sale, covering manufacture, sale, and service provision. GST is designed to tax only the value addition at each stage. Example. If you buy a book, GST collected includes tax from the paper manufacturer, printer, distributor, and retailer, but you pay only the final GST inclusive price. Continuous chain of tax credits. One of GST's key features is the input tax credit ITC system, which allows businesses to claim credit for the GST paid on inputs, goods or services bought for business use. This creates a continuous chain of tax credits, avoiding the cascading tax effect tax on tax. Businesses subtract the GST paid on inputs from the GST collected on sales. This makes the system efficient and cost-effective. Example. A textile manufacturer pays GST on raw cotton, claims credit for it, and pays tax only on the value added when selling the cloth. Goods and Services Tax Network GSTN. GSTN is an IT infrastructure platform for administering GST in India. It manages registration, GST return filing, tax payments, and data storage. Enables seamless electronic management of GST-related processes. Connects taxpayers, government authorities, and stakeholders. Simplifies compliance and monitoring. GST model. India follows a dual GST model with taxes levied and collected by both the center and the state's union territories. CGST Central GST. Tax collected by the central government on intrastate sales. SGST State GST. Tax collected by state governments on intrastate sales. UTGST Union Territory GST. Tax collected by union territories without legislature on intra-UT sales. IGST Integrated GST. Tax collected by center on interstate sales and imports, later shared between center and states. Integrated Goods and Services Tax Act, 2017. This act governs interstate supply of goods and services, ensuring seamless taxation across state borders. Applies to goods services moving from one state to another. IGST is levied to prevent double taxation. Ensures credit flow between states, maintaining the tax credit chain. Nature of supply. Section 7 to 9 of IGST Act. The term supply is broadly defined to include sale, transfer, barter, exchange, license, rental, lease, or disposal made or agreed to be made for a consideration. Includes import of services. Includes activities specified as deemed supplies even without consideration, e.g. gifts or free samples above a value threshold. Territorial waters supply. Section 9. Supply in the sea zone under Indian jurisdiction is treated like inland supply. Definitions where necessary. Supply. As explained above under Section 7 to 9, it means all forms of supply of goods or services for consideration in the course of business. Taxable person. Someone registered or required to register under GST who supplies goods or services. Intrastate supply. Supply within the same state UT. Interstate supply. Supply from one state UT to another. Input tax credit ITC. Credit of tax paid on inputs that can be used to reduce tax on output. Place of supply. The location where goods or services are consumed, determining the jurisdiction for tax collection. Composite supply. A supply of two or more goods or services naturally bundled and supplied in conjunction, e.g. meal combo. Mixed supply. Multiple supplies that are not naturally bundled and can be separately identified, e.g. gift pack with various items. Union Territory Goods and Services Tax Act, 2017. This act deals with GST for union territories without legislatures like Lakshadweep, ensuring GST is collected similarly but administered under the UTGST Act. Applies mostly to UTs without legislatures. Jammu and Kashmir and Ladakh have specific applicability rules due to their special status. Ensures tax uniformity in all Indian territories. Applicability of GST on Jammu and Kashmir and Ladakh. Post-reorganization, GST law is applicable in J&K and Ladakh. Aims to integrate these regions into the national GST framework smoothly. Merger of Daman and Diu and Dadra and Nagar Haveli. These two UTs have merged into a single union territory. GST administration and compliance are unified accordingly. Administration and powers of officers. GST officers have powers to Register taxpayers. Conduct audits and investigations. Issue notices and penalties. Collect taxes and enforce GST laws. Maintain records. Levy and collection of UTGST. UTGST is levied on goods and services supplied within union territories without legislatures, similar in nature to SGST. Exemption from GST. Certain goods and services are exempt to reduce burden on essential items or sensitive sectors. Examples: fresh fruits and vegetables, healthcare services, education services, unprocessed food grains. Small taxpayers below turnover thresholds are exempt. Exemptions promote social welfare and support small businesses. Payment of tax. Taxes paid online periodically, monthly or quarterly. Payment can be adjusted using input tax credit. Timely payment is mandatory to avoid penalties. Utilization and order of input tax credit. ITC can be used first to pay IGST, then CGST, and then SGST or UTGST as per prescribed order. Helps maintain smooth tax credit flow and avoids blocking of credits. Transitional input tax credit. Credit available on stock of inputs held before GST introduction. Allows businesses to smoothly transition from old tax regime to GST. Includes credits on taxable and exempt goods, and switch from composition schemes. Advance ruling. Mechanism for taxpayers to get clarity on GST treatment of supplies. Helps prevent disputes and bring legal certainty. Rulings are binding on the applicant and tax authorities for that case. Power to make rules and regulations. GST Council and relevant authorities have powers to formulate rules, regulations, and issue instructions. Helps clarify law, update provisions, and resolve implementation difficulties. The Goods and Services Tax Compensation to States Act, 2017. Provides compensation to states for revenue loss during transition to GST. Funded by a compensation cess on luxury and sin goods. Compensation paid for 5 years post-GST rollout. Ensures fiscal stability for states adopting GST. Lesson 16. Levy and collection of GST. Taxable event. The taxable event under GST is the supply of goods or services. Tax becomes payable when a supply happens. Tax is charged only on taxable supplies. Supply must be in the course of business. GST is a tax on consumption, so the place of supply also matters. Concept of supply. Supply is the backbone of GST. It includes sale, transfer, barter, lease, rental, or disposal of goods or services for a consideration. Supply can be of goods, services, or both. Includes transactions made in the course or furtherance of business. Includes import and export. Supply without consideration is also included when specified, e.g. gifts above a certain value. Meaning and scope of supply. The scope of supply defines what transactions are covered under GST. It covers all forms of supply like sale, transfer, barter, exchange, license, rental, lease, or disposal. It includes imports and interstate supplies. It also includes certain transactions made without consideration. Schedule 1. Schedule 1 lists supplies treated as considered supplies even if made without consideration. Permanent transfer or disposal of business assets. Supply of goods by one related person or distinct person to another in the course or furtherance of business. Supply of goods or services between principal and agent. Import of services by a taxable person from a related person outside India. Schedule 2. Schedule 2 classifies supplies into goods or services, helping determine tax treatment. Transfer of title in goods is supply of goods. Transfer of title along with insured delivery is supply of goods. Hiring, renting, leasing, licensing goods is supply of services. Works contract services are treated as supply of goods. Schedule 3. Schedule 3 lists transactions not treated as supply under GST. Services by employee to employer in course of employment. Services of court or tribunal. Functions performed by MPs, MLAs, and politicians. Sale of goods after seizure by authorities. Supply of goods or services by a purely agricultural society to members. Composite and mixed supply. Composite supply. 2 or more supplies bundled naturally and supplied together, where one supply is principal dominant. The tax rate of the principal supply applies. Mixed supply. 2 or more supplies bundled intentionally and supplied together, but can be supplied separately. Tax rate applied is the highest among bundled supplies. Examples. Composite. A laptop with warranty laptop is principal. Mixed. Gift basket with chocolates, wine, and flowers tax on highest rated item applies. Levy and collection of CGST and IGST. CGST and SGST are levied on interstate supplies within one state. IGST is levied on interstate supplies and imports. Section 9 of CGST Act, Section 5 of IGST Act, and Section 7 of UTGST Act govern levy and collection. Tax rates are notified by GST Council. Exemptions under GST. Some goods and services are exempt. Examples of exempt goods include basic food items like grains, fresh vegetables. Services like healthcare and education services are exempt. Provided under notifications issued by the government. Businesses supplying only exempt goods services cannot claim input tax credit. Power to grant exemption from tax. Central and state governments have powers to grant general or special exemptions. Section 11 of CGST Act and Section 6 of IGST Act empower this. General exemptions apply routinely. Special order exemptions are case-specific. Distinctions between general and specific special order exemption. General exemption applies broadly to a class of goods services. Specific exemption is granted to a particular person or transaction on request order. Exempt supply. A supply on which GST is not charged but input credits cannot be claimed. Zero-rated supply. Supplies exported are to SEZs. Tax is charged at zero rate. Input tax credit is available. Businesses can claim refunds on zero-rated supplies. Difference between nil-rated, exempt, zero-rated, and non-GST supplies. Term description input tax credit available. Term description input tax credit available. Nil-rated supply with 0% GST rate yes. Exempt supplies not subject to GST number. Zero-rated exports and supplies to SEZ taxed at 0% yes. Non-GST supply transactions outside the scope of GST no. Services exempt from tax. Examples include healthcare services, educational services, services by charitable institutions, and so on, as per government notifications. Composition Scheme Section 10 of CGST Act. Simplified tax scheme for small taxpayers. Turnover limit for eligibility is Rs. 1.5 crore rupees. 75 lakh for NA states. Tax paid at a fixed rate on turnover varies by type of business. No input tax credit allowed. Quarterly return filing instead of monthly. Cannot collect tax from customers separately. Option to opt out if turnover exceeds limit or other disqualifications occur. Mainly intended to ease compliance for small businesses. Eligibility to opt under composition scheme. Small taxpayers with turnover below threshold. Manufacturers, traders, restaurants excluding alcohol. Service providers with turnover up to Rs. 50 lakhs under a specific subsection. When option will lapse and restrictions. Option lapses if turnover exceeds limit or conditions violated. Composition taxpayers cannot collect tax from customers. Payment of tax under composition is final and no ITC is available. Procedural aspects of composition scheme. Intimation through prescribed form must be filed. Applies from the beginning of the financial year for which option is made. Liability to pay GST. Registered persons liable to pay GST. Person making taxable supply except exempt supply. Person required to deduct tax under reverse charge. Suppliers of goods or services notified under reverse charge. Goods notified under reverse charge section 9(3). Reverse charge means tax is paid by the recipient instead of the supplier. Includes services like legal services, sponsorship, supply of coal, etc. Applies when supplier is unregistered and recipient is registered. Services notified under reverse charge notification number 13/2017. Legal services by advocates. Sponsor of events. Services supplied by government or local authority to a business. Reverse charge on supplies to registered person from unregistered supplier. Taxes to be paid by registered recipient. Applicable for specified goods and services. Lesson 17. Time, value and place of supply in GST. Supply. Supply means all forms of supply like sale, transfer, barter, exchange, license, rental, lease, or disposal of goods or services for a consideration made in the course or furtherance of business. Time of supply. The time of supply is the point in time when goods or services are considered supplied, which determines the date on which GST becomes payable and which GST return the transaction should be recorded in. Time of supply of goods Section 12 of CGST Act, 2017. For goods, time of supply is the earliest of date of issue of invoice, or last date by which invoice should be issued. Date of receipt of payment, either date payment entered in books or credited to bank, whichever is earlier. Example. If invoice is issued on January 10th, payment received on January 15th, time of supply is January 10th. Time of supply in forward charge mechanism Section 12(5). Forward charge means supplier collects and pays GST. Time of supply is earliest of invoice date or payment receipt. If advance payment is received, time of supply is date of advance receipt. If invoice not issued within prescribed time of supply will be due date of invoice. Time of supply in reverse charge mechanism Section 12(3). Reverse charge means recipient pays GST instead of supplier. Time of supply is earliest of O date of payment by recipient. O date when recipient records the supply in books. O date when recipient is required to pay tax under reverse charge. Time of supply in case of vouchers Section 12(4). When vouchers are supplied, time of supply is O date of issue of voucher if identifiable, or O date on which voucher is redeemed used. Time of supply in all other instances Section 12(5). For supplies not covered by above, time of supply is earliest of date of issue of invoice or last date of invoice issuance. Date of receipt of payment. Date on which supply is recorded in books. Time of supply for recovery of interest, late fee, etc. Section 12(6). Time of supply for recovery of interest or penalties is date when they are recovered. Time of supply of services Section 13 of CGST Act, 2017. Similar to goods, but with these variations. Time of supply under forward charges earliest of O date of invoice, O date of payment receipt, O date when invoice is due to be issued if invoice not issued. Under reverse charge, earliest of O date of payment by recipient, O date when supply recorded in books, O date when tax payable under reverse charge. Time of supply of services in case of vouchers Section 13(4). Same as goods. Date of issue or redemption of vouchers. Time of supply in case of all other instances Section 13(5). Similar rule to goods. Earliest of invoice date, payment date, or accounting record date. Time of supply for recovery of interest, late fee, etc. Section 13(6). Date on which monetary recovery of interest or late fee occurs. Time of supply in case of change in rate of tax Section 14 of CGST Act, 2017. When tax rate changes after supply made, time of supply is earlier of O date when supplier declares revised tax rate, O date when supplier receives payment. Value of taxable supply Section 15 of CGST Act, 2017. Value of supply means the price actually paid or payable for the supply of goods or services between unrelated parties, excluding taxes but including various costs. Inclusions in determination of value of supply Section 15(2). Value includes packing, commission, transport, insurance, etc. Any taxes excluding GST charged separately. Subsidies linked to supply. Exclusions in determination of value of supply Section 15(3). Value excludes GST itself, discounts given after supply if recorded in invoice, certain other amounts as notified. Where value cannot be determined under above provisions Section 15(4). If value can't be determined under 15(1), 2, or 3, it shall be determined under prescribed rules. Valuation rules, CGST rules, 2017. Rules 27 to 35 define special valuation methods for different cases like when consideration is not wholly in money Rule 27. Between related persons Rule 28, 29. Based on cost Rule 30. For lottery, betting, gambling Rule 31A. Pure agents Rule 33. Conversion rate for foreign currency Rule 34. Value including integrated, central, state tax Rule 35. Place of supply. Place of supply determines the location where the supply is considered to take place. This is important to determine which state or union territory's GST applies. Place of supply of goods other than import and export Section 10 IGST Act, 2017. For goods when movement involved. Location where goods are delivered. For goods without movement. Location where goods are at the time of supply. Place of supply in case of import into, export from India Section 11 IGST Act, 2017. Import. Place of supply is location of importer in India. Export. Place of supply is location outside India. Place of supply of services Sections 12 and 13 IGST Act, 2017. Varies based on the nature of services. If both supplier and recipient are in India, place of supply generally is location of recipient. If recipient is outside India or supplier is outside India, special rules apply to determine place. Some services have specific place of supply rules like location of a movable property, performance. Section 13 determines place of supply where location of supplier or recipient is outside India. If either supplier or recipient location is outside India, specific rules under Section 13 are used. Helps classify supply as export or import of services for GST purposes. Clarifications issued on place of supply. Government has issued clarifications to resolve ambiguities in determining place of supply in certain transactions, ensuring uniformity in GST administration. Lesson 18 Input Tax Credit ITC and Computation of GST Liability. Overview. Input Tax Credit ITC allows a registered GST taxpayer to reduce the tax paid on inputs goods or services used for business from the tax payable on outputs goods or services sold. It effectively lessens the overall tax burden, ensuring no cascading effect of taxes. Definitions. Input Tax Credit ITC. The credit of GST paid on inputs and input services which can be claimed and utilized to offset the GST liability on outward supplies. Input. Goods or services used in business. Eligible dealer. A registered person eligible to claim ITC. Eligible document. A tax invoice or debit note issued by GST registered suppliers. Input service distributor ISD. An office of the same entity receiving input tax credit and distributing it to other units. Credit ledger. An electronic ledger where ITC is recorded. Eligibility and conditions for claiming ITC Section 16. A person can claim ITC if all of the following conditions are met. They are registered under GST. They possess a valid tax invoice or debit note issued by the supplier. They have received the goods or services. The supplier has paid the GST to the government and filed the appropriate returns. They have furnished the required returns e.g. GST R3B. The ITC has been claimed within the due time limit see below. The goods services are used for business purposes. For capital goods, depreciation has not been claimed on the GST component Section 16. Tax TMI. Restrictions and ineligible ITC Section 17.5. ITC will not be available in the following cases. Goods used exclusively for personal consumption. Goods used for exempt supplies. Motor vehicles except for certain specified purposes. Goods services used for non-business activities. Goods disposed of as gift or lost destroyed, etc. GST paid on goods sent to job workers with rules for claiming ITC. Blocked credits as per the law e.g. motor vehicles unless for specific purposes. Conditions for claiming ITC. Possession of invoice or debit note from the supplier that is valid. Receipt of the goods or services. Payment of tax by supplier. Filing of GST returns mainly GST R3B. Claiming within time limit, which is maximum time limit to claim ITC. The earlier of, the 30th of November of the subsequent financial year, or date of filing annual return GST R9. E.g. For supplies in FY 2022-23, ITC must be claimed by 30 November 2023 or by filing GST R9 due by December 31, 2023. Procedure for claiming ITC. Possession of a valid tax invoice debit note. Goods services must be received. GST paid must be paid to government. Properly filed GST returns like GST R3B. Claimed in the prescribed return period. Utilization of ITC. ITC can be used to pay GST liabilities. First, IGST, then CGST, then SGST UTGST. If excess ITC remains, it can be carried forward or claimed refund in specific cases like exports. Cases of ineligible and blocked credits goods services used for personal use. Goods that are blocked or excluded under law. Instances where depreciation is claimed on the tax component of capital goods. Transitional provisions. If transitioning from old tax regimes, businesses can claim transitional credit for stock and inputs. Conditions apply for stock sent for job worker sent to other units. Special cases and rules. Goods sent to job worker. Special rules determine when ITC can be claimed. Input service distributor ISD can distribute ITC to various units based on prescribed rules. Reversal and recovery. Excess ITC claimed wrongly must be recovered with interest. Calculation of GST liability. GST liability is the difference between output GST tax collected on sales minus input tax credit of purchases. Accurate computation ensures no tax evasion and compliance. Lesson 19. Procedural compliance under GST. Rules for registration Chapter 3. Registration is the process by which a person becomes a GST taxpayer, getting a unique GST identification number GSTIN to comply with GST laws. Registration. Getting registered under GST means you are recognized by tax authorities to collect and pay GST. GSTIN Goods and Services Tax Identification Number. A 15-digit unique number given to every registered taxpayer. Used for tax filing, invoices, and GST communication. Persons liable for registration Section 22. Persons with taxable turnover exceeding prescribed limits. Casual taxable persons temporary suppliers. Non-resident taxable persons. Agents, e-commerce operators, input service distributors. Persons not liable for registration Section 23. Those with turnover below threshold. Agriculturalists some exceptions. Others exempted by government notifications. Compulsory registration Section 24. Even if below turnover limit, registration compulsory for interstate suppliers, casual and non-resident taxable persons. Persons required to deduct collect tax at source. E-commerce operators. Procedure for registration Section 25. Application filed electronically. Verification by tax authorities. Registration certificate issued within 3 working days. Separate registration for different places of business allowed. Application for registration Rule 8. Use prescribed electronic application. Provide details like PAN, business address, constitution. Attach required documents. Verification of the application and approval Rule 9. Tax officer verifies the application. Can seek clarification or reject incomplete applications. Approval leads to issuance of registration certificate. Issue of registration certificate Rule 10. GST registration certificate issued electronically. Contains GSTIN and details of the taxpayer. Separate registration for multiple places of business Rule 11. Businesses having multiple locations in a state must obtain separate registrations for each place. Grant of registration for persons deducting or collecting tax Rule 12. Persons required to deduct TDS or collect TCS GST must also register. Grant of registration to non-resident taxable person Rule 13. Non-residents supplying goods services in India must register for GST. Suo moto registration Rule 16. Tax authorities can assign registration on their own if a person is found conducting taxable business without registration. Assignment of unique identity number to special entities Rule 17. Entities like ISDs or casual taxable persons receive unique identity numbers for compliance. Display of registration certificate and GSTIN Rule 18. Registered persons must display certificate and GSTIN at business premises prominently. Amendment of registration Rule 19. Registered persons can amend details like address, business constitution. Must notify changes online. Application for cancellation of registration Rule 20. Procedure to voluntarily cancel registration when business closes or ceases taxable supplies. Registration liable to cancellation Rule 21. Tax authorities can cancel registration for non-compliance or cessation. Suspension of registration Rule 21A. Registration can be suspended to prevent tax evasion. Cancellation of registration Rule 22. Formal cancellation process on request or by authorities. Revocation of cancellation of registration Rule 23. Cancelled registration can be reinstated upon fulfillment of conditions. Physical verification of business premises Rule 25. Authorities may physically check premises to verify business existence. Method of authentication Rule 26. Applications and documents authenticated electronically by digital signatures. Deemed registration Section 26. A person is deemed registered if tax authorities do not act within prescribed timeline. Special provisions for casual and non-resident taxable persons Section 27. Specific registration rules for temporary or non-resident suppliers. Amendment, cancellation, suspension of registration Sections 28 to 30. Procedures to amend, cancel, suspend, or revoke registration as per law. Tax invoices, debit and credit notes. Tax invoice. Document showing supply details, tax charge. O must have GSTIN, invoice number, date, description, value, tax amount. Continuous supply invoices issued periodically. Revised invoices allow corrections. Small value invoices less than 200 rupees may have relaxed rules. Debit and credit notes used for tax adjustments after invoice issuance. Contents and manner of issuing invoice Rule 48. Includes supplier and recipient details, description, quantity, tax rates, etc. E-invoicing mandated for large taxpayers for standardization. Payment voucher, bill of supply, receipt voucher, refund voucher. Different types of GST documents for supplies, payments, tax-exempt supplies, refunds. Credit and debit notes rules. Documents for adjustments in price or tax post-original invoice. Tax invoice in special cases Rule 54. Special rules for exports, job work, supplies to cess, and other specific cases. Transportation of goods without invoice Rule 55. Authorization needed for moving goods without issuing a tax invoice. Accounts and records. Maintain records of inward and outward supplies, invoices, payment details. Records must be kept for 6 years. Can be maintained electronically. Location of records declared at registration. Electronic way bills. E-way bills. Required for movement of goods over specified value limits. Enables tracking and verification of goods in transit. Returns Sections 37 to 39. Monthly quarterly electronic filings of outward supplies, inward supplies, ITC details. Separate returns for composition taxpayers. Quarterly return monthly payment QRMP scheme available for small taxpayers. Levy of fee Section 47. Late fees or penalty fees for delay in filing returns or payments. Payment of tax, interest, penalty Section 49. Tax payments done electronically. Interest penalizes delayed tax payments. Penalties for non-compliance. Electronic liability, credit, and cash ledgers Rules 85 to 87. Digital accounts for taxpayers' tax liabilities, input credit balances, and cash deposits. Rules govern utilization order and restrictions. Identification number for each transaction Rule 88. Unique transaction numbers help track GST payments and returns. QRMP scheme Rules 61, 61A. Simplified filing for small taxpayers. Quarterly returns, monthly payments. Refund procedures Sections 54 to 56 and rules. Refund for excess tax paid, unutilized ITC, or exports. Online application and documentation required. Interest paid on delayed refunds. GST practitioners. Certified agents who help taxpayers comply with GST. Must pass exams and register with authorities. Assessment. Self-assessment. Taxpayers calculate and pay tax. Provisional, scrutiny, summary, best judgment. Various methods used by tax officers to check compliance or determine tax dues. Demand and recovery CGST Chapter 15. Procedures to recover unpaid tax. Issuance of show cause notices to provide reasons for demand. Time limits fixed for issuing notices and penalties. Powers for attachment and sale of property to recover dues. Police assistance available to enforce recovery. Lesson 20. Overview of Customs ACT. Introduction. Overview of customs laws. Customs laws regulate the import and export of goods across a country's borders to protect economic interests and collect duties. Governed mainly by the Customs Act, 1962. Controls movement of goods, levies duties, prevents smuggling. Ensures compliance with international agreements. Provides procedures for import, export, warehousing, and transit. Rules and regulations. Various rules and notifications frame specific provisions such as classification, valuation, exemptions, reporting, and penalties under customs. Includes Customs Tariff Act, Customs Valuation Rules. Govern procedural details and enforcement. Rules can be amended to adapt to changing trade. Definitions Section 2. Important definitions include customs duty, tax on goods imported or exported. Import, bringing goods into India by land, sea, or air. Export, sending goods out of India. Goods, Includes merchandise, cargo, stores, baggage. Assessable value. Value on which duty is calculated. Person in charge PIC. Person responsible for goods during transit. Levy and collection of customs duties. Customs duties are levied on imported and exported goods as per law. Duties must be paid before clearance of goods. Collection supervised by customs officers. Delay in payment leads to penalties and interest. Levy of an exemption from customs duty. Customs duty levied on import and export unless exempted. Exemptions provided for certain goods under notifications. Exemptions promote trade, essential goods, or treaty benefits. Types of customs duties. Main types include Basic Customs Duty BCD, Standard Applicable Tax, Additional Duty of Customs CVD, to counter domestic taxation, Special Additional Duty SAD, to counter sales tax impact, Anti-dumping duty, to prevent unfair trade dumping, Safeguard duty, to protect domestic industry, Protective duty, to prevent importation of harmful goods, Import duty, duty charged on goods brought into the country. Rate depends on tariff classification, determined after assessing value and classification. Duties must be paid for goods to clear customs. Classification and valuation of import and export goods. Classification. Goods are classified under the harmonized system of nomenclature HSN in customs tariff. Classification affects duty rate. Rules of interpretation apply to resolve doubts. Goods description and nature determine classification. Interpretation rules under Customs Tariff Act, 1975. 6 rules to classify composite and ambiguous goods. Include heading priority, packaging evaluation, and residual classification. Ensure consistent tariff application. Valuation for customs duty. Value of goods declared determines duty payable. Must reflect transaction value price actually paid. Adjustments made for freight, insurance, commissions. Ensures fair taxation and avoids under-invoicing. Valuation rules. Customs valuation determination of value of imported goods rules, 2007. Sequence to determine value if transaction value is not reliable. Includes computed value and fallback methods. Exemptions under Customs Act. Specific goods exempted from customs duty via notifications. Include diplomatic cargo, certain imports by charitable institutions. Administration of customs laws. Officers of customs law. Officials empowered to enforce customs laws. CBI, customs, central excise officers involved. Powers include search, seizure, assessment. Establishment under customs. Customs stations, warehouses, transit sheds. Required infrastructure to perform customs operations. Administration. Administered by the Central Board of Indirect Taxes and Customs. Coordination between ports, airports, land borders. Import and export procedures under customs law. Clearances, documentation, and inspections. Submission of bill of entry or shipping bill. Compliance with customs notifications essential. Responsibilities of a person in charge PIC. Custodian responsible for goods still cleared. Ensure goods not tampered or illegally diverted. Accountable for proper handling and documentation. Entry of goods on importation section 46. Goods must be declared to customs at point of entry. Documents and bill of entry must be presented promptly. Failure attracts penalties. Transportation. Movement of goods within customs limits. Movement requires proper documentation. Transport of imported goods often under customs escort. Transit and transshipment. Goods may pass through multiple customs locations. Transshipment. Transfer between conveyances under customs control. Rules ensure goods not diverted or entered improperly. Transit of goods without payment of duty section 53 allows movement of imported goods without paying duty till clearance point. Under customs seal and surveillance. Transshipment of goods without payment of duty section 54. Movement between ports or places while in customs control. Goods remain uncleared during transit. Warehousing. Storage of imported goods pending duty payment or clearance. Includes public and private bonded warehouses. Goods can be stored without paying duties temporarily. Baggage rules. Customs rules for personal baggage of travelers. Allowances for duty-free imports within limits. Excess goods liable to duty and examination. Duty drawback. Refund scheme where exporters get back customs duty paid. Incentivizes exports. Requires documentation proving export and duty payment. Demand and recovery. Demand of duty. Customs can demand unpaid or short paid duty. Show cause notices issued for recovery. Confiscation of goods and conveyances. Goods or vehicles involved in customs violations can be confiscated. Confiscation independent of penalty imposition. Refund. Refunds allowed for excess duty paid or wrongly collected. Applies to import or export duty. Procedure requires application and documentation. Assessment of duty section 17. Duty amount assessed based on valuation and classification. Includes provisional and final assessments. Officers empowered to reassess if errors found. Tag, tracking device or data logger. Customs may require goods to have tracking devices for security. Prohibitions. List of goods banned or restricted under customs law. Includes narcotics, hazardous materials, counterfeit goods. Offenses. Smuggling, misdeclaration, undervaluation. Penalties, fines, and imprisonment possible. Advance ruling. Procedure for importers exporters to seek advance clarification on classification, valuation, or duty liability. Provides legal certainty and avoids disputes. Settlement Commission. Authority for resolving disputes by settlement between taxpayer and customs without litigation. Encourages voluntary compliance.